Hello and welcome to this video on the payback method of investment appraisal. In this video, we're going to look at why firms might wish to make an investment. We're going to investigate the payback period approach to assessing whether a business should do an investment and look at the limitations of the payback method. So let's start off with what we mean by an investment. Well, a business might consider investment in a number of different ways, perhaps developing a new product, maybe expanding into new markets, maybe thinking about strategies to increase market share or expand production capacity, or maybe develop new technology. By investment, we mean anything that costs a business that has a long-term return to the business. So a strategic decision with a long-term consequence. Now, if you ran a business, you might want some techniques, some approaches that you could use to appraise or evaluate or assess, decide which one you should do, the investment options or projects that you have available to you. So investment appraisal techniques are techniques that allow a business to assess the financial returns of an investment or make comparisons between investment projects. There are three types that we need to be aware of: payback, accounting rate of return, and net present value. In this video, we're looking at payback, the first one. But to do any of these different approaches, we need certain information. We need the initial capital cost of the investment. We need the yearly cash inflow, the yearly cash outflow, and the lifespan of the investment. And we would normally put this information into a table and then do some calculations to work out which is the best investment or whether we should go ahead with the investment. So let's look at payback first of all. Payback period is a time it takes for a project to repay its initial investment outlay. Let's have a look at an example. We're going to imagine a factory is considering investing in a robot. Here it is, the little gizmo. And we've got this information here. Purchase cost of the robot is £60,000. The yearly running cost is £10,000. And the yearly return we get from having the robot is £30,000. The robot is expected to last for 5 years. You might want to pause the video here and think if you can do straight up, calculate how long would it take for this robot to pay back the initial investment. Well, what we would normally do is develop a table here. We've got the 5 years of the robot's life. Every year the return coming in was £30,000 after it's been invested. The yearly running cost was £10,000. We've got that going out. We also know the purchasing cost of the robot was £60,000, so that goes out instantly in year 0. And then what we can do is look at the net cash flow for each year. So in year 0, net cash flow is minus £60,000, and then every subsequent year we have the robot, it generates £20,000 coming in. Okay. So the question would be, how long does it take for the robot to repay its initial investment? Well, after a year, we've had £20,000 come back in, but we spent £60,000 on the robot, so it hasn't recovered it. We've still got £40,000 to go. After year 2, we've had £40,000 come in. That doesn't quite cover the £60,000 we spent, so we've still got £20,000 to go. By the end of year 3, we've had £60,000 come in, which covers the initial £6,000 we spent. So our cumulative net cash flow of 0 indicates that by year 3, we have paid back the initial outlay. So the answer would be the robot pays back in exactly 3 years. That's how long it took for the robot to pay back the money that was spent on the initial investment. And that's it. That's payback period. Now, unfortunately, we don't always get a nice round number like it pays back in exactly 3 years. Sometimes our calculation has to be a little bit more complex. So let's look at another example here for our robot gizmo. And this is what we're going to assume this time. We're going to assume the robot costs £80,000. That's the initial capital outlay. Its annual return is £45,000, and its annual running costs are £15,000. So again, we can see our table here. The lifetime of the robot 1 to 5 down the side. It generates a net cash flow of £30,000 in each year, and has cost us £80,000 in year 0. Again, the cumulative net cash flow, we can see minus 80,000 and then minus 50,000 once the first 30,000 has come in, and so on, all the net cash flows added together. Now, straight away, we can see there's not a year here where the net cash flow, the cumulative net cash flow is 0. So there's not a nice round answer. By the end of the third year, it has more than paid back. So it's not going to be an exact number of years. So how do we go about calculating the payback period in this scenario? Well, the first step is to look at the year in which the payback is finally achieved. So if we look at our table, at the end of year 1, payback is not achieved, still 50,000 to go. At the end of year 2, 20,000 still to go. At the end of year 3, the project has paid back. So we know that the payback period is going to occur during the course of the third year, which means our payback period is going to be 2 years and a certain amount of months. And what we need to do is work out how many months that is. At what point during the third year will payback be achieved? To do this, we need to follow step 2. We need to take the amount still needed at the start of the year of payback and divide by the net cash flow for that year. Then if we times that by 12, we will get the month of payback because there are 12 months within a year. Effectively, we're saying is what percentage or proportion of the way through the year are we going to get to reach payback? And we times that by 12 and it will tell us the month. So if we look at our table again, we know it's going to pay back during the course of year 3. And how much money do we still need at the start of the year of payback, at the start of year 3? Well, we still have £20,000 to go to reach 0. And how much is the net cash flow for year 3? Well, it's £30,000. So the project needs to generate £20,000 more to pay back, and in year 3 the net cash flow is £30,000. So what will be the month of payback? Well, this is the formula we use. It's the amount required, 20,000, divided by the net cash flow in the year of payback, 30,000, then we times it by 12 to work out the month. So effectively what we're saying here is it's 2/3 of the way through the year. So 20,000 over 30,000, 2/3 times 12, 8 months. So what would be the period of payback for this little robot gizmo? It would be 2 years and 8 months. This is an important approach and it's the most commonest way of calculating payback, so please make sure you have the steps and the formula down in your notes. The firms can use the payback period in 2 ways. They can set an upper limit on the time allowed for payback, and any project which does not or is not expected to pay back within this period is rejected, or they can maybe rank projects according to the speed at which they pay back. So we might say that robot 2 here is preferable to robot 1 because it pays back over a slightly shorter time. This may be particularly relevant if perhaps the business is short of cash. So we've looked at why firms might wish to make an investment and we've looked at the payback approach. Now let's look at the limitations of payback. So the pros and cons of payback. Well, one of the advantages is it focuses on cash, which is important in businesses with weak cash flow. Another advantage is it emphasizes the speed of return, which is maybe important in dynamic markets where we need our projects to pay back quickly so that we can move on to the next one. Some disadvantages. Well, maybe we get the money back within 2 years, 8 months rather than 3 years, but actually that ignores any future cash flows and the size of those future cash flows. If the first robot was going to be much more, much higher return overall later on, that might have actually been a preferable project. So it doesn't take that into account, which may be a disadvantage. It might lead to a short-termist approach. So people might choose the best project in the short term, but actually in the long term, they're not choosing the most profitable one. It also ignores qualitative factors. Yes, maybe the equipment paid back quickly, but was that equipment going to produce products of sufficient quality to encourage a greater return in future? Some other things to consider. Did the investment actually marry with our objectives? And if not, then maybe just because it pays back quicker might not be more relevant. We also didn't consider necessarily the financial aspects of financing it. If it costs a lot more perhaps, but it pays back quicker, is that better or worse? Depends how much money the business has available. Maybe we haven't taken into account the overall risk of the project and the risk of the cash flows that we've assumed. How likely is it that robot is going to generate those cash flows? Maybe we haven't appreciated the effect on the workforce. Perhaps a new robot might lead to demotivation of the workforce, and so it might have a quick payback. It might not be beneficial for our business in the long term. And lastly, are there any environmental or ethical concerns with our investment that we should consider? Maybe it pays back quicker, but maybe it's more polluting. So we looked at why firms might want to make an investment. We've looked at the payback approach, and we need to be able to do those calculations. And finally, we've looked at some of the benefits and also the limitations of payback. That's it. Thank you.